Chapter 4 Examples for Cost Accounting, AC 323. In Chapter 4, we look at job costing systems and how costs flow through job costing systems. So in this example, we're going to look at the journal entries that record how costs flow in job costing systems. And we're going to look at overhead calculations. So for number 1, we're asked to compute the company's predetermined overhead rate for the year. Well, overhead is calculated by total overhead costs divided by its allocation base. So in this example, we have $1,980,000 of factory overhead costs, and we use an allocation base of 66,000 machine hours. So we would take that 1,980,000 divided by 66,000, which gives us an overhead rate of $30 per machine hour. And that is how we apply overhead to jobs throughout the year. The second thing this problem asks us to do is to prepare journal entries to record the events that occurred during the month of April. So we have an example of things that occurred during the month of April. This typo is actually in the textbook. The wrong company. So A, we purchased 180,000 pounds of material on account. The cost was $5 per pound. So when we're going to journal that, we're going to record that we received materials and we now owe on an accounts payable. We can just say materials inventory. Materials inventory, $180,000 pounds times $5 a pound is $900,000. And we're going to credit accounts payable. B, we issued 120,000 pounds of materials to production, of which 15,000 pounds were used as indirect materials. So we're going to be removing those from materials. So we are going to be crediting materials in this journal entry. 120,000 pounds are direct materials and 15,000 pounds are indirect materials. So when we record direct materials to jobs, to production, this means that we have started creating work in process inventory. So we're going to add those material costs to work in process inventory. 120,000 times $5 per pound is $525,000. The 15,000 pounds of indirect materials will be recorded in overhead, $75,000. The total amount is credited to our materials inventory. Journal entry C, actual direct labor costs of 240,000 and 40,000 of indirect labor costs. We record direct materials, direct labor, and overhead costs to work in process inventory. So our direct labor costs will be recorded to work in process inventory, $240,000. The 40,000 of indirect labor costs we will record to overhead. And then our payroll account for 280,000. D, we record depreciation on equipment for the month, $75,700. Depreciation is an overhead expense. We debit overhead for $75,700 and we credit accumulated depreciation equipment. For E, we recorded insurance costs for the manufacturing property, $3,500. So insurance is an indirect cost that gets added to overhead. And we're going to credit prepaid insurance. In a service company, this might be a insurance expense, but in a manufacturing company, we're going to record that to overhead. Transaction F. We pay $8,500 cash for utilities and other miscellaneous items for the manufacturing plant. These are all overhead costs of $8,500, and we paid with cash. Transaction G, we completed a job costing $7,500 and job G28 costing $77,000 during the month and transferred them to the finished goods inventory account. So we need to move these two jobs from our work in process inventory into finished goods inventory so they are available for sale. So we're adding to our finished goods inventory and reducing our work in process inventory account. If we add $77,000 plus $7,500, we get $84,500. Transaction H. We have shipped job G28 to the customer. The job was invoiced at 35% above cost. So remember that we have two journal entries anytime that we record a sale of inventory. We have the cost of goods sold, when we remove the product from finished goods inventory. The cost of job G28 was $77,000. Then we need to record the sale. We invoiced the job, which gives us an accounts receivable. And we record sales revenue. It tells us that the job was invoiced at 35% above cost. So we take 77,000 times 1.35 to get our sales price of $103,950. Our last transaction is to allocate our overhead using our predetermined overhead rate for the month of April. So we use 7,700 machine hours during the month of April, and we have $30 per machine hour as our predetermined overhead rate. We allocate overhead in a job costing system. We record it to work in process inventory. We take 7,700 hours times $30 per machine hour, and that is $231,000. When we allocate overhead, that is a credit to overhead. When we record actual overhead, it is a debit to overhead. The last item asks us to compute the amount of, or second to last item, asks us to compute the amount of over-applied or under-applied overhead. So we need to make an overhead T account. And calculate whether or not we over or under applied overhead. So we have a debit to overhead of $75,000, a debit to overhead of $40,000, debit to overhead of $75,700, $3,500, $8,500, and then a credit to overhead of $231,000. So if we sum our debits and our credits, we can calculate how much our actual was versus our applied. So we have our actual overhead versus our applied or allocated overhead. So we over applied overhead. The amount on the credit side is our estimate or an application over overhead, and the amount of the debit side is our actual costs. We over applied overhead $28,300. So the last thing we want to do is close that account. When we close the overhead account, we close that amount to cost of goods sold. And these are the journal entries that we use to look at the way that materials, labor, and overhead flow through a job costing system.